Okay, so, we're diving into a pretty big topic today.
Yeah, big one for a lot of people, especially, if you're here in California,
Right, exactly.
thinking about selling your home.
And we're talking about all the stuff around capital gains.
Capital gains when you sell that place you've been living in.
Exactly. And we've got some really interesting resources to dig into this time.
Yeah, we do.
Articles from the California Franchise Tax Board.
That's the ftb.k.gov for anyone who wants to look it up themselves.
Perfect. And then also a piece from Rooster Homes.
Yeah, they've got a pretty practical take on this whole thing.
And I think our mission here really is to kind of untangle this for people.
Totally, because it can get confusing.
Oh, absolutely.
Now, we're going to break it all down, like what does capital gains tax even mean?
Right, like starting with the basics.
Exactly. And then how does California do it differently than the feds?
Yeah, because that's a whole other layer.
And then that super important 2-year rule for primary homes.
Oh, yeah, that comes
Yeah.
up all the time.
And you know what happens if things don't go to plan?
Right, life throws a curveball.
What if you need to sell sooner?
Yeah, like what are the implications there?
Exactly. So let's get into it.
Perfect. Okay, so first things first.
Yeah, let's define our terms.
When we say capital gains and capital losses,
What are we even talking about? Give us the simple version.
Imagine you sell something like your house for more than you bought it for.
Okay, makes sense.
That profit you make, that's your capital gain.
Got it. So it's like the difference between what you sell it for and what you originally paid.
Exactly, that positive difference.
And then the flip side of that, I'm guessing, is the capital loss.
You got it. So if you sell something for less than what you paid, that's a capital loss.
Okay, and both of those are important for like tax purposes.
Huge. And in California, those FTB articles we mentioned,
Yeah.
Franchise Tax Board,
They're pretty clear you have to report both.
capital gains and losses.
Everything got to keep them in the loop.
Okay, so California wants to know about all of it, profits and losses.
They want the full picture.
Now, here's where it gets really interesting and kind of uniquely Californian.
Right, buckle up.
How does our state handle these capital gains differently from the federal government?
Okay, so this is a big one, unlike the feds. California doesn't have a lower tax rate just for capital gains.
Whoa, so no special treatment?
No, here in California, all capital gains, they're taxed like regular income.
Oh, wow. So whatever your income tax bracket is.
That's the rate they'll use for your house sale profits too.
So that's a huge difference.
Definitely something to keep in mind.
So unlike at the federal level where you might get a lower rate in California, it's all treated the same.
Exactly. It's all part of your overall income.
Wow. Okay, so you've made your profit, you're ready to file taxes.
Time for the paperwork.
How do you actually report these gains both to the feds and to California?
Okay, so federally, those FTB resources mentioned, IRS Form 1040,
Right, the standard one.
and then Schedule D, which is specifically for capital gains and losses.
Okay, so that's where you break it all down.
Exactly. And then for California, well, if there's any difference between how the feds in California treat your capital gains,
And there often is.
right, because we tax it as ordinary income.
Yeah.
You need to file California Schedule D, which is Form 540.
Got it. And that's where you kind of reconcile everything.
Yeah, make sure both the feds and California have the info they need.
Perfect. Okay, now let's get to that 2-year rule everyone's always talking about.
Ah, the principal residence exclusion.
Right, the 2 out of 5 year thing.
Exactly. So this is a big deal for homeowners.
It is because it can potentially save you a ton of money in taxes.
It can, for sure.
Yeah.
Basically, it lets you exclude some of the profit from the sale of your main home.
Okay, that's a good thing.
It is, and it actually aligns with IRS rules, so it's kind of a win-win.
So what are the specifics here? Like, what do you need to do to qualify?
Okay, so the key is ownership and use.
Ownership and use.
You have to have both owned and used the property as your main home
Okay.
for at least 2 out of the 5 years before you sell it.
So 2 years owning it, 2 years living in it as your main home.
Exactly, within that 5-year window.
Okay. And if you meet those requirements, what kind of savings are we talking about?
So for individuals, you can exclude up to $250,000 in profit.
Wow.
And for married couples or registered domestic partners filing jointly,
RDPs.
yeah, it doubles up to $500,000.
That is a lot of potential tax-free profit.
It is.
Now, are there any specific conditions for married couples or RDPs to get that full $500,000?
Yeah, there are a few things to keep in mind.
Okay.
Generally, you need to file jointly when you sell the home.
Makes sense.
And at least one spouse or RDP has to meet that 2 out of 5 year ownership rule.
Okay.
But both spouses or RDPs need to meet the 2 out of 5 year use rule.
Got it. So it's not just about being married or registered. You both have to have actually lived there.
Right. And one more thing, neither you nor your spouse or RDP can have used this exclusion on another home sale
Oh, interesting.
within the 2 years before this sale.
Okay, so it's not something you can just keep claiming over and over.
Nope. There's a bit of a cool down period.
So 2 years ownership, 2 years living there as your main home, and you can't have used the exclusion recently.
You got it.
Now, the FTB mentioned something really important here.
What's that?
If your profit is actually below those exclusion amounts,
The $250,000 for individuals or $500,000 for couples.
yeah, and you meet all the requirements,
Ownership and use.
then you might not even have to report the sale on your taxes at all.
Exactly. Less paperwork.
That is definitely a win.
It is, but what if your profit is higher than those limits?
What if you've got a bigger gain?
Well, then anything above those thresholds, that's taxable.
Okay.
And remember, in California, we're taxing that extra profit as regular income.
Right, which could be up to that 13.3% we talked about.
Yep. So that 2-year rule is super important.
It is. It can really make a difference.
Big time.
But let's talk about those curveballs, those unexpected things.
Because life happens.
It does. What if you need to sell before you've lived there for 2 years?
Yeah, like Rooster Holmes was talking about.
Exactly what if it's a job relocation or a family emergency, something out of the blue.
Right. Something you didn't plan for.
So what happens then?
Well, the general rule is that if you sell before 2 years,
You don't get the exclusion.
in most cases, no.
Ouch. So what does that mean for your taxes?
Potentially a much bigger bill.
Oh, no.
Because any profit you make could be subject to both federal capital gains tax
And California income tax.
and your full income tax, right?
Up to that 13.3%.
Possibly. That could really eat into your profits.
That's a significant hit.
It can be. But Rooster Holmes did mention there might be some exceptions.
Right. They said there might be ways around that 2-year rule.
Yeah, sometimes.
So what are those?
Well, they're usually for what they call unforeseen circumstances.
Unforeseen circumstances.
Yeah, so things like a job change that forces you to move.
Okay, so like a relocation.
Exactly.
Hmm.
Or serious health problems.
Yeah, wow.
Or other major life events that make you sell sooner than you planned.
So like imagine you have to move to take care of a sick family member.
Exactly, something like that.
But Rooster Holmes was pretty clear about this.
What's that?
These exceptions, they're very specific.
Very case by case.
And you'll probably need documentation.
Yeah, you got to prove it.
And the California Franchise Tax Board, their website has more details.
Yeah, if you're in this situation, definitely check it out.
So it's not a guaranteed exclusion, but it's worth looking into if something unexpected happens.
Absolutely.
Now, Rooster Holmes also had some great advice about what to do before you even list your house.
Oh, yeah, they had some good tips.
Especially if you haven't hit that 2-year mark yet.
Right, because you want to be prepared.
So what did they recommend?
Okay, first talk to a local real estate agent
Before you do anything.
before you even think about selling.
Why is that so important?
They can give you what's called a comparative market analysis.
CMA.
Yep, it's basically an estimate of what similar homes in your area have sold for recently.
Oh, that's super helpful.
It gives you a realistic idea of your home's market value.
So you can see how much profit you might make.
Exactly, or even if you might take a loss.
Right. It's all about knowing where you stand.
Absolutely. And real estate agents, they're the experts in the local market.
Makes sense. They know what's going on.
They do.
Yeah.
And their second big piece of advice was to talk to a tax professional.
Like a CPA.
Yeah, someone who really understands capital gains taxes.
So why is that so crucial?
Well, they can help you figure out your potential gain or loss.
Right.
They can see if any exemptions or deductions apply to you.
Especially with those exceptions to the 2-year rule.
Exactly. And they can help you understand your potential tax liability.
So no surprises come tax time.
That's the goal.
Rooster Holmes really stressed the importance of getting that professional advice.
They did. They said it can save you from a lot of headaches later on.
And it might even help you find ways to save on taxes.
Yeah, sometimes a tax professional can spot things you might not have thought of.
So it sounds like it's definitely worth the investment.
Totally. Knowledge is power in this situation.
Absolutely. Okay, so let's go back to calculating your gain.
Back to basics.
How do you actually figure out how much profit you've made?
Okay, so you start with your selling price.
The final amount?
Yep, and you subtract what's called your adjusted basis.
Adjusted basis. Now that sounds complicated.
It's not too bad. Basically, your basis is what you originally paid for the home.
Okay, the starting point.
Right. But the adjusted part comes in when you add the costs of any improvements you've made.
Oh, so like if you remodeled the kitchen or added a deck?
Exactly. Things that add value to the property.
So you add those costs to your original purchase price.
You do. And then you subtract that whole amount from your selling price.
And that gives you your capital gain.
Exactly. And the FTB, they recommend checking out IRS Publication 523.
which is called
Selling your home.
appropriately named.
It's got a lot of details on how to calculate your gain or loss and how much of it might be taxable.
Wow. Okay, so we've covered a lot of ground here.
This is a complex topic.
It is, but I think we've given our listeners a really good overview.
Yeah, I hope so. Let's just recap those key points. Okay, so first big difference. California taxes all capital gains,
Right.
is ordinary income.
Right, unlike the federal government.
Exactly.
All
So
right.
keep that in mind.
Definitely. And then the 2-year rule, that principal residence exclusion.
Yeah, that's a big one. It can save you up to $250,000 for individuals.
Or $500,000 for married couples and RDPs.
But you have to meet those ownership and use requirements.
2 years owning it, 2 years living there.
Exactly. And then if you have to sell before that 2-year mark,
You're probably looking at capital gains taxes.
both federal and state.
But there might be exceptions for unforeseen circumstances.
So it's worth doing your research.
Absolutely. And last but not least.
The advice from Rooster Homes.
Oh, yeah, that was gold.
Talk to a local real estate agent
Before you do anything else.
and then talk to a tax professional.
To get all your ducks in a row.
Yeah, they can guide you through the whole process.
Such good advice.
It is.
So on that note, here's something for our listeners to ponder.
Okay.
Life is unpredictable, right?
It is.
Things don't always go according to plan.
Never.
So how might knowing all these capital gains rules,
Yeah.
how might that affect your decisions about buying a home in the future?
Interesting question.
And your overall financial planning?
Yeah. It's something to think about.
Because these rules, they have long-term implications.
They do, for sure.
So it's worth taking the time to really understand them.
Definitely.
Thanks for joining us for this deep dive, everybody.
Yeah, thanks for listening.
We'll see you next time.
Bye.